In this video, I'll break down the 8 Bitcoin rules you can't break, straight to the point so you can save time and protect your assets. What's more, the further the video progresses, the more powerful the rules become. The last one could literally change your life. Remembering that this content is 100% free and you can subscribe to receive more videos like this. Well, the first one is Bitcoin is not like the other cryptos. Being very honest here, when I first bought Bitcoin in 2012, it was still super uncertain. There weren't thousands of guys on the internet producing educational content about it. It wasn't bought by big companies or big billionaires. And of course, I don't invest in anything without knowing how it works, so I knew how it worked. I just didn't yet understand how important it was and whether it would actually catch on. And the risks seemed too much, because even today, Bitcoin has a lot of risk, which is why I talk about diversification all the time. But before, it was worse because it wasn't time-tested. After all, there was no point in the project being incredible if people didn't buy it. And you can't judge me, okay? Especially since most of you only bought after 2012. So this is where this rule fits in. Bitcoin is much more than I imagined back in 2012, and it is definitely different from other cryptocurrencies. Most cryptos can change the rules, print more tokens, or are controlled by a company or a small group. Bitcoin isn't like that. It has a fixed supply of 21 million coins, and that number will never change. About 95% are already mined, and the last ones will only show up more than 100 years from now. That's why Bitcoin is scarce, like digital gold. Another big difference: Bitcoin has no boss. There's no CEO, no foundation, no company behind it. The creator disappeared in 2010, and since then the network is run by thousands of people all over the world. That makes it truly decentralized. Every other coin has someone in charge, and if that person fails, the project can die. And one more thing, Bitcoin didn't have an ICO, no pre-sale, no early investors taking the biggest piece of the pie. The only way to get it in the beginning was by mining. That's why it's the fairest launch in history. What does this mean? I believe that your cryptocurrency portfolio should never have a massive exposure to altcoins. In fact, I think the vast majority should be in Bitcoin. That's what I do. And I'll talk more about this in the video. The second rule is Bitcoin has risks. This is more for the people who blindly believe in Bitcoin and invest their entire life savings in it. Because every time I talk about Bitcoin and diversification, I get a ton of comments criticizing me, and I understand. But please hear me out. The risks are real, visible, and have been openly discussed since its creation. One of the main concerns is mining economics. Bitcoin is kept safe by miners, people who use computers and electricity to protect the network. As a reward, they earn new Bitcoins. But here's the catch. Every 4 years, that reward is cut in half. So over time, miners get fewer Bitcoins for the same work. Some people worry that one day mining won't pay enough and miners will just quit. Another often cited issue is quantum computing. If powerful enough, a quantum machine could break the cryptography that secures Bitcoin addresses. Experts agree this threat is still decades away, but the community is already preparing quantum-resistant solutions. Because Bitcoin's code is open source, an upgrade is possible if the threat ever becomes imminent. There's also the question of mining centralization. At one point, most mining power was in China, which created fears of control. When the country banned mining in 2021, however, the network quickly adapted as miners relocated to the US, Kazakhstan, and other regions. This episode showed both the vulnerability of centralization and Bitcoin's resilience when attacked. Volatility is another clear risk. Prices can fall 70% during a bear market and rise 500% during a bull cycle. For newcomers, these swings can be devastating if they invest without understanding the long-term nature of the asset. Finally, there is the adoption risk. If people lose interest or stop using it, Bitcoin could decline. However, after 16 years of crises, bans, hacks, and market crashes, adoption continues to grow. Countries like El Salvador already use it as legal tender, and more companies add it to their balance sheets each year. Bitcoin's risks are not hidden. They are public, debated, and evolving. Mining costs, quantum computing, centralization, lost keys, volatility, regulation, competition, and adoption challenges are all real factors to consider. Yet the fact that Bitcoin has faced each of these head-on for more than a decade and remains alive shows its resilience and its ability to adapt. Well, rule number 3, you can start small. One Bitcoin costs tens of thousands of dollars, but each coin can be divided into 100 million Satoshis. So you can start with $10, $20, or $50. whatever you can afford. Here's the point. If you buy $100 of Bitcoin today, you're not too late. You'd still get thousands of Satoshis, and those small buys add up. People who started with just a few dollars a week years ago now have life-changing amounts. I talked about how much Bitcoin is enough and how 0.1 can generate a good returns in the future. You can see it in the card above. Fourth rule, don't trade Bitcoin. Let's imagine you're just a normal guy with a normal job and not a millionaire yet. Please don't let yourself be corrupted by the greed of trading. Here's why. It's almost impossible to perfectly guess Bitcoin's tops and bottoms. And if you try, you'll most likely miss out on huge gains. Let's look at the math. From 2017 to 2021, Bitcoin went from around $1,000 to nearly $69,000. If you simply bought and held $1,000 at the start, you'd have turned it into about $69,000 at the peak. Now imagine you tried to trade along the way. Even if you got most of the moves right, missing just the 10 best days of performance would have cut your return by more than 50%. And history shows that Bitcoin's biggest gains often come in sudden bursts, right after massive crashes, the exact moments when most traders panic and sell. I learned this lesson the hard way. Back in the day, before Bitcoin even existed, I used to trade stocks, and I wasn't bad at it. Actually, I was pretty good. But here's the truth. Even being talented, even being a so-called outlier, I spent my entire days stuck to the screen. Hours of stress, endless anxiety, chasing tiny price moves just to end up making the same money an average worker makes. Meanwhile, when I shifted my focus to building businesses, I earned much more. Why? Because my time is the most scarce resource I have. It's worth far more than the pennies I squeezed out of trading. And if you're truly smart, your time will create more wealth in real work, creativity, and entrepreneurship than in guessing the market's next move. That's why I say, even if you can trade, it's still not worth it. Short-term trading consumes your time, your energy, and often your peace of mind. Long-term investing, on the other hand, lets you put money to work while you focus on living, building, and creating. And with Bitcoin, history shows that patience pays off. Those who held through the cycles ended up with life-changing gains, while most traders lost their coins trying to time the market. Studies show that around 90% to 97% of day traders lose money after fees. That's a lot. You would probably be part of that statistic. Don't be fooled. If it were simple, we would all be becoming millionaires trading from our chairs at home. Now, rule number 5, iconic. Not your keys, not your coins. If your Bitcoin is sitting on an exchange, it's not really yours. It's just a promise that one day they'll give it back to you. And promises can be broken. History is full of examples. In 2014, the exchange Mt. Gox collapsed and over 850,000 Bitcoins disappeared. In 2022, the giant exchange FTX went bankrupt and millions of people lost access to their funds overnight. These weren't scams in the shadows. They were the biggest names in the industry at the time. When your coins are on an exchange, you don't control the private keys, the digital password that proves ownership. Without that key, you don't own Bitcoin. The exchange does. All you own is a line in their database. The solution is simple. Move your Bitcoin to a wallet where you control the keys. Write down your recovery phrase, store it safely, and never share it. Only then can you truly say, this Bitcoin is mine. Because remember, if it's not your keys, it's not your coins. Okay, but if this key is so important and is the key to your freedom, where should you keep it? That's the 6th rule. Use the right tool. Think of your Bitcoin like cash. You don't walk around with your entire life savings stuffed in your wallet, right? You keep a little bit for daily use and the rest stays safe in the bank or a vault. With Bitcoin, it's the same. For small amounts, money you might want to send, spend, or test things with, you can use a hot wallet. These are wallets connected to the internet, like apps on your phone. They're practical, fast, and perfect for everyday transactions. But for larger amounts, your savings, your long-term stack, you need a cold wallet. This is a device that stays offline, like a digital safe. Brands like Coldcard, Jade, or Keystone are made exactly for this. They keep your private keys completely disconnected from the internet, which makes it nearly impossible for hackers to touch your coins. The point is simple. Don't treat all your Bitcoin the same way. Daily cash belongs in your pocket. Long-term savings belong in a vault. Use the right tool for each situation, and you'll protect yourself from both hackers and your own mistakes. Rule number 7, privacy is not the default. Bitcoin is transparent by design. Every transaction is permanently recorded on the blockchain, showing when coins moved, how much, and between which addresses. This makes the system open and verifiable, but it also means your activity is not private by default. If you buy Bitcoin on an exchange, your personal information is usually linked to those coins. From that point on, movements from that address can be tracked. Data leaks from exchanges or service providers have shown how easily this information can spread. That's why it's important to understand that Bitcoin is not anonymous. Some people use tools and methods to increase privacy, but these come with trade-offs and risks. At a basic level, it's good practice to avoid reusing addresses and to be cautious about where and with whom you share your wallet information. Privacy in Bitcoin is possible to improve, but it requires deliberate action. By default, every transaction is public. Rule number 8, don't trust, verify. In the traditional system, you trust the bank to tell you your balance, you trust the government not to print too much money, and you trust intermediaries to keep their promises. With Bitcoin, it works differently. Here, you don't need blind trust. You can check everything yourself. Bitcoin's code is open source, meaning anyone can read it and confirm the rules, like the 21 million supply cap. There are more than 300 active developers working on Bitcoin's code today, and every change is reviewed by the community, not hidden behind closed doors. If you run Bitcoin Core, your software independently verifies every block and transaction, making sure they follow the rules. You don't have to believe anyone. Your computer does the math. Think of it like buying groceries. You don't just trust the cashier, you check your receipt. Or like looking at your wallet balance on your phone, except this time it's not the bank telling you, it's the math confirming directly. That's the power of don't trust, verify. With Bitcoin, you're not relying on promises, you're relying on transparency and mathematics. That's it, cousins. Stay invested.